Hey there, welcome back to the channel. Today, we're diving into a question that's on a lot of people's minds when they start building wealth. Should I invest in stocks or real estate? It's a classic debate, and honestly, it's not a simple one-size-fits-all answer. Both options have their strengths, their quirks, and their challenges. So grab a coffee, get comfy, and let's break this down together. We're going to look at the risks, the potential returns, tax advantages, how easy each one is to get started with, and the barriers you might face. By the end, you'll have a solid framework to decide what's right for you, or maybe even why doing both could be the ultimate move. Let's get started. First up, let's talk about risk. Every investment comes with some level of uncertainty, and neither stocks nor real estate is a guaranteed win. With stocks, you're diving into the world of the market. Prices can swing wildly based on economic news, global events, or even just investor sentiment. One day, your portfolio's up 10%. The next, it's down 5%. That volatility can feel like a roller coaster. For example, during a market crash, you might see your investments take a serious hit, sometimes losing 20% or more in a matter of weeks. The good news? Historically, the stock market tends to recover over time, but you've got to have the stomach to ride out those dips. Plus, you're not tied to one single stock. Diversifying across different sectors can spread out that risk. Real estate, on the other hand, has its own flavor of risk. When you buy a property, you're putting a big chunk of money into one asset. If the local housing market tanks or your neighborhood takes a hit, your investment could lose value. Then, there's the risk of tenants. If you're renting out a property, you might deal with late payments, property damage, or even vacancies that leave you covering the mortgage out of pocket. And don't forget maintenance costs. A leaky roof or a broken furnace can eat into your profits fast. That said, real estate often feels less volatile than stocks because property values tend to move more slowly. But slow doesn't mean safe. Natural disasters, zoning changes, or unexpected repairs can throw a wrench in your plans. So, which is riskier? It depends on your perspective. Stocks can feel like a wild ride with daily price swings, but real estate ties up a lot of your money in one place, which can feel riskier if that one property hits a rough patch. Now let's talk about the juicy part: return potential. This is where both stocks and real estate can shine, but they do it in different ways. For stocks, historical data gives us a pretty good picture. According to studies from financial researchers, the stock market has delivered an average annual return of about 7 to 10% after inflation over the long term. That's not a guarantee for the future, but it's a solid benchmark. You might have a stellar year with 20% gains, followed by a year where you're barely breaking even. But if you're patient and stay invested for decades, those returns can compound into something impressive. Real estate returns are a bit trickier to pin down because they depend on where you buy, how you manage the property, and whether you're flipping houses or renting them out. A report from a major real estate research group suggests that rental properties can generate annual returns of 6 to 8% through a mix of rental income and property appreciation, though some markets can see higher gains. If you're flipping properties, buying low, fixing them up, and selling high, you could see returns of 20% or more on a single deal, but that's a lot more work and risk. Leverage, like using a mortgage, can boost your returns in real estate because you're controlling a big asset with less of your own money up front. But leverage is a double-edged sword. If the property value drops, you're still on the hook for that loan. Here's a quick example to put it in perspective. Let's say you invest $100,000 in the stock market at an average 8% annual return. That could grow to about $217,000 in 10 years with compounding. In real estate, if you put that $100,000 as a down payment on a $500,000 rental property, and it appreciates at 4% per year while generating 3% in rental income after expenses, you could end up with a similar return, potentially more if you use leverage wisely. But both come with risks, and past performance isn't a crystal ball for the future. Next up, let's dive into tax advantages, because who doesn't love keeping more of their money? Stocks have some nice tax perks. If you hold on to your investments for more than a year, you qualify for long-term capital gains tax rates, which are typically lower than regular income tax rates. think 15% or 20% depending on your income, compared to ordinary tax rates that can hit 37%. If you're investing in a tax-advantaged account like an IRA or 401k, you can defer taxes on your gains entirely until you withdraw the money. Or in the case of a Roth IRA, potentially avoid taxes on gains altogether. Real estate, though, is like the tax-advantaged superstar. When you own a rental property, you can deduct a ton of expenses: mortgage interest, property taxes, insurance, repairs, and even depreciation, which is essentially a tax break for the wear and tear on your property. Depreciation lets you reduce your taxable income without spending actual cash. Plus, if you sell a property and make a profit, you can use something called a 1031 exchange to defer paying capital gains taxes by rolling that profit into another property. And if you live in the property as your primary residence for at least 2 years, you can exclude up to $250,000 of capital gains from taxes when you sell, or $500,000 if you're married. That's a huge win. But here's the thing. Tax advantages only matter if you're making money to begin with. And both stocks and real estate require you to understand the tax rules or work with a pro to maximize those benefits. Don't just wing it. Tax mistakes can be costly. Let's talk about ease of implementation. How hard is it to actually get started with these investments? Stocks are hands down the easier option to jump into. You can open a brokerage account online in minutes, deposit some cash, and start buying shares with a few clicks. You don't need to be an expert to invest in a diversified fund that tracks the market. Set it and forget it. Real estate? It's a bit more hands-on. Buying a property means dealing with realtors, inspections, paperwork, and financing. If you're going the rental route, you're basically running a small business. You've got to find tenants, handle leases, fix leaky faucets, and maybe even deal with evictions. Hiring a property manager can make it more passive, but that cuts into your profits, typically 8 to 10% of your rental income. Flipping houses is even more intense, requiring you to coordinate contractors, manage budgets, and time the market just right. It's not impossible, but it's definitely not as simple as clicking buy on your phone. That brings us to barriers to entry, which is a big one. Stocks have a super low barrier to entry. You can start with as little as $100, or even less if you're using an app that lets you buy fractional shares. There's no gatekeeping. Anyone with a bank account and an internet connection can get in the game. Real estate, on the other hand, has a much higher barrier. Buying a property usually means coming up with a down payment, anywhere from 3.5% to 20% of the purchase price, depending on the type of loan. Okay, folks, we have made it through a lot of this video, and we hope you're finding this breakdown helpful. If you're enjoying the content, go ahead and hit that like button. It really helps the channel grow. And if you want more investing tips like this, hit that subscribe button and ring the bell so you don't miss a thing. All right, let's keep going. So we've covered the risks, returns, tax benefits, ease of getting started, and barriers to entry. At this point, you might be thinking, okay, but which one should I choose? Here's where things get interesting. The truth is, you don't necessarily have to pick one over the other. Stocks are great for liquidity and diversification. You can sell your shares in seconds if you need cash, and you can spread your money across hundreds of companies or even entire markets with a single fund. It's low maintenance and perfect for building wealth over time, especially if you're starting with smaller amounts of money. Real estate, meanwhile, offers the potential for steady cash flow from rent, powerful tax breaks, and the ability to leverage other people's money to control a bigger asset. It's more hands-on, but it can create a tangible income-producing asset that feels more real to a lot of people. If you're just starting out, stocks might be the better first step because of their low barrier to entry and simplicity. You can dip your toes in, learn the ropes, and build up some capital. As your wealth grows, say you've got a solid emergency fund, some stock investments, and at least a few $100,000 saved up. That's when real estate starts to make sense. Once you reach a certain level of wealth, let's say you've got a net worth in the 6 figures or more, diversifying into both stocks and real estate is probably the smartest move. Why? Because they don't always move in lockstep. When the stock market's having a rough day, real estate might hold steady, or vice versa. Of course, this assumes you're willing to put in the work to learn both. Before we wrap up, we want to hear from you. What's your take? Are you team stocks, team real estate, or maybe you're already mixing it up? Drop a comment below and let's get the conversation going. And if you found this video helpful, don't forget to give it a thumbs up and subscribe for more tips on building wealth the smart way. Thanks for watching, and we'll see you in the next one.